Everyone is asking the wrong question. Can Meta make money from AI? I don't think that is the real investment question, because unlike OpenAI, Anthropic, or xAI, Meta does not need AI to become a profitable business. It already is. So today, we are asking a different question. What if AI is simply making Meta's existing money printing machine even stronger? Welcome to Model and Market. Every week, our AI investment committee debates one stock, challenges the market consensus, and makes a real portfolio decision. I'm Emma. Let's find out. Rupert, the market is celebrating Meta's new AI model, custom chips, and plans to sell enterprise computing capacity. But why does any of this actually matter for shareholders?
Because investors are looking at Meta as if it is becoming another AI company. I think that is the wrong framework. Meta already owns one of the most profitable businesses on Earth. It generated more than $115 billion in operating cash flow, while still producing over $46 billion in free cash flow after massive infrastructure investment. That is a very different starting point from companies still trying to prove that AI can become a business.
So AI does not need to justify Meta's valuation as a completely separate business.
Exactly. For OpenAI, AI is the business. For Meta, advertising is still the business. AI is there to improve recommendations, keep users engaged for longer, and make advertising more effective. Even a small improvement in engagement or advertising efficiency can create enormous value, because Meta is applying AI to an advertising engine that already operates at global scale.
Daniel, Meta may be able to afford this investment, but does that automatically mean shareholders will earn a good return from it?
No. Affordability is not the same as return on invested capital. Meta is committing enormous amounts of money to AI infrastructure. If those assets do not improve advertising economics or generate meaningful new revenue, free cash flow and margins could come under pressure. The main risk is not that Meta runs out of money. The risk is that management spends billions building capacity faster than it can generate an acceptable return. A strong balance sheet can absorb poor investment. It cannot turn poor investment into shareholder value.
That distinction matters. The question is not whether Meta can survive the AI arms race. The question is whether the money being invested strengthens the economics of the core business. Meta is also developing custom AI chips and expanding its own data center infrastructure. Rupert, is this simply about reducing dependence on NVIDIA?
It is bigger than that. Meta is not just buying computing power. It is buying control. Custom chips, data centers, networking, and proprietary models allow Meta to optimize more of the AI stack around its own workloads. That could lower long-term costs, improve performance, and reduce dependence on external suppliers. And because very few companies can afford investment at this scale, the spending itself may become a barrier to entry.
So the $145 billion infrastructure plan may not only be a financial risk, it could also be part of the moat.
Potentially. But investors should not assume that scale automatically creates a moat. Custom chips still have to perform, infrastructure still has to be utilized, and Meta still has to compete with Amazon, Microsoft, and Google if it wants to sell computing capacity.
Does Meta need to build another AWS for this thesis to work?
No. That is the key point. Selling enterprise compute is optional upside. Meta does not need to become a dominant cloud provider. The investment can still work if AI improves engagement, advertising conversion, and operating efficiency inside its existing platforms. If excess computing capacity also becomes a new revenue stream, that turns part of an existing cost center into a profit center. But the core thesis does not depend on that happening.
So the market may be framing Meta as a social media company trying to become an AI infrastructure company. But perhaps Meta is still an advertising company using AI infrastructure to reinforce its existing advantage. Daniel, what would prove this thesis wrong?
I would change my view if capital expenditure continues rising while advertising growth, margins, and free cash flow weaken. I would also worry if Meta's custom infrastructure fails to reduce costs or if enterprise demand does not materialize. The thesis breaks when AI stops strengthening the core business and becomes an expensive ambition that shareholders are forced to finance indefinitely.
The committee reached a buy decision, not because we expect AI subscriptions or enterprise compute to transform Meta overnight, but because Meta can fund the AI race using cash generated by an already dominant business. The opportunity is that AI strengthens engagement, advertising efficiency, and strategic control. The risk is that capital expenditure grows faster than the economic return. That makes cash flow and return on invested capital the numbers that matter most. If there is one thing to remember, it is this. Meta does not need AI to become profitable. It needs AI to make an already extraordinary business even stronger. Sometimes the biggest opportunity is not creating a new business. It is making your best business almost impossible to catch. See you next time.